We're now at the end of the year, and BTab needs to prepare its year-end financial statements. Before it does, though, it needs to take into account some of the transactions that necessarily were recorded originally, but have not been taken into account since they were originally recorded. And let's look at the first example here. And the first example would be the loan from Lincoln's grandmother to BTab for $60,000. The loan was for 3 years, and interest is due annually on the anniversary date, and the loan rate is 6%. Well, the company actually, the loan was made on September 1st. So how many months have passed? Well, the whole month of September, October, November, and December. So 4 months have actually passed since the loan was originally made. And typically loans accrue interest on a monthly basis. So we have a $60,000 loan. Okay. Interest rate is at 6%, and 0.06 is equivalent to 6%. We're going to multiply this out, and we get a rate of $3,600. Now, this would be the interest on an annual basis, because interest rates are always stated on an annual basis. Okay, interest rates are always on an annual basis. So this is the annual interest, but only 4 months have passed since the loan was made. So we're going to multiply this by 4 over 12. And this is the numerator here is the number of months the loan has been outstanding, and the denominator is the number of months in a year. So this number is always 12, and it's always a constant. So this is the months outstanding. So if we multiply that out, we get an amount. So basically it's 1/4 or 1/3 of the 3,600. So we get $1,200. So our journal entry then will be, so we have to record basically $1,200 of interest expense. Now, it won't be paid yet. It won't be paid until later. It won't be paid until the following September 1st, because that's when interest payments are made. So we're going to have to make a journal entry, though, because this is when the interest actually accrued in this period. So we're going to record an interest expense of $1,200. And we're going to record an interest payable of $1,200. And think about our terminology again. This is it accrued? Yes, it's an accrued expense, which means what? It means that we have recognized the expense in the current period, but it's not realized. Now the question is, why do we recognize the expense in this period? Because the expense happened in this period. The loan was made September 1st. The loan was outstanding for 4 months in this first year. And so that interest actually is tied to that year, and we need to record the expense in that year. And this is a concept we're going to talk about a little bit more later, is what we call periodicity. And we need to isolate revenues and expenses in the periods in which they incur. All right, so that's the first of, that's our first adjusting journal entry number 1, our interest expense.